to the computer. Brilliant. So if we hand over to Bukola and we'll get started.
Great. Hello, can everyone hear me? Can you hear me?
Yeah.
Great. Okay. Hello, everyone, and welcome, and thanks for joining us this afternoon. I'm sure you'll gain various hints and tips from the sessions this afternoon that you can start to use straight away. We have various experienced speakers speaking this afternoon. Who are we? We are JGB Accountants and Business Advisors, and the speakers we have speaking this afternoon are Tony Goodman, MBE, Steve Saunders, Robert Simpson, Dipentanian, and myself, and we're going to be covering these agenda points. There will be questions and answers at the end of the presentation, so please feel free to enter them in the chat box and we'll take them at the appropriate time. There'll be plenty of time after the presentation to answer your questions, so please bear with us. We have a lot to cover this afternoon, so I'd like to hand over to Steve Saunders. He will start the session. Enjoy and thank you.
Lovely, thanks Bukola, thanks very much. Brilliant, so yeah, let's get straight into it really. I know when this is probably my reaction when we first heard of the coronavirus in China, and thinking, right, I'm going to put my head in the sand. I'm sure it's not going to come over to here. We've heard these things before with SARS and Ebola and all sorts of other things that have happened. So let's put our head in the sand and pretend we're an ostrich, or this is me playing on the 18th hole and in a bunker looking for my ball. So whichever way around you want to look at it. So certainly things are going to change and have changed dramatically. So it's important to stress that we need to control our mindset and work on the things that we can control rather than the things that we can't control. So maybe this might help to explain it a little bit further. So this is a sort of change curve. So admittedly, it's the start of the pandemic. There's probably that sort of shock. I still can't get over the fact that the Olympics has been cancelled. And you think we've only ever cancelled an Olympics when there's been a world war raging. So you think that we've actually not doing the Olympics this year is amazing. So that's that shock. A bit of denial's crept in for sure. And then people started getting frustrated and angry about the situation. And certainly a lot of people would be perhaps very depressed about things. And certain businesses I work with are certainly in that situation really, where they're looking, well, where is the future? Where are we going? What is going to be happening? And unfortunately, we can't control the virus and its spread other than doing the things that the government request. And again, they're playing things by ear as they learn more about the virus and how it spreads. So there is that bit more of acceptance, and we're probably now up into that sort of problem solving stage. So how can we get our businesses up and running? So for instance, this virtual webinar wouldn't be something that we'd be doing perhaps before, probably in January or February, we'd have probably been meeting face to face. But it's actually works out quite nicely that we can draw in more people from lots of different places, and it's actually pivoted and changed the way we do business. So we are very resourceful as human beings, so we're looking into that problem solving mode. So we've got a formula or a line, if you like, that we use as a mindset line. So this is the line, and it's the line of choice. So you can choose whether you want to be below that line in your thinking. So you're looking to you're looking to blame other people for the things that are happening around you. You're making excuses, and you're perhaps living in denial. So they are things that you are putting into your mind and making up a reason why things aren't happening. So what we're looking to do, we want to be above that line, and we want to be responsible. Oh, sorry, can someone just mute themselves, please? That's great, lovely, thanks Samuel. So really, as I say, we're looking to be responsible for our own actions. As human beings, we don't fly south for the winter, we don't swim upstream to spawn out as a salmon would. So we're responsible for our actions, and we're accountable for those actions, and we do take ownership. So we're looking to be above the line. Be aware that you can perhaps drop below that line on occasions, but be aware that you are in that sort of mode where you are looking at being in that area for you're making excuses, blaming others, and being in denial. Because ultimately what happens is the bottom part there below the line and reasons why things don't happen. So they're perhaps excuses for things that don't happen. And we really want to be in above that line. So we want Can you just mute yourself there, please? You can, that's it, brilliant, thanks very much. So we want to be above that line, and that's above the line is where we can get some results. So we, certainly one of our coaches said, you can either have results or excuses. You can't really have both. So really look in this mindset theme, really we want to be looking and being around people that are energizing and forward thinking and positive people, as opposed to people that are draining our energy. So we want to be looking to avoid those kind of people and spend our time with the forward thinking, go-getting people. So that's kind of hopefully sets the scene for this afternoon session. So think about what you can do rather than what you can't do. So I'd now like to hand over to Tony. So if you'd like to take control, Tony, of the presentation, that would be fantastic. Oh, Tony, you're on mute.
Yep, that's it.
That's it.
I'm here.
Perfect.
I'm here. Great to see you all. And I'm going to talk about how setting up a business can go and when is a good time to do that. And one of the things that's prompted this is that I'm often asked, is now a good time to start this business, to start my business, to start any business? And it's natural that when you're thinking of having a career change or starting a business, to have doubts and to put obstacles in the way. The first step is to decide that you do want to start a business and that that is something that you're going to do in changing your life, either as a full-time or as a part-time option. And what are the normal problems that you get with that? When is a good time to start that business? Everyone's concerned whether it's going to be a success or a failure. And sometimes it's easier to envisage that failure than it is to envisage the success. And people think now we're in the middle of a crisis still. We know that there's a recession. But what I'd say to you is many businesses succeed in a recession. And if you look out there, you'll see stories of many, many businesses doing incredibly well. And similarly, many businesses will fail during a boom. So of course, we're hearing a lot about the high street and businesses that have failed there. But a lot of those were failing long before the virus struck. So it isn't necessarily related. These terms shouldn't frighten any small business. There are opportunities in all of them. Good ideas, well thought out and well delivered, can always do well. I'm going to share with you the secrets of my success. What makes a good business? It's very simple. The right product in the right place at the right price. Meeting a need at an acceptable price. And that applies whether it's a product or a service. It doesn't make a difference. It's a matter of understanding your marketplace and what is required. And in order to do that, there are some simple things that you need to do. You need to research. You need to research until you're confident that you understand what it is that you're trying to do. Consider innovation versus traditional. And in order to do that, look at the trends from around the world, because you may well find that an idea that's working in America, or an idea that's working in Africa, or an idea that's working in China is something that could be adopted here. A lot of businesses in the UK have started that way, and a lot of businesses that are now selling around the world started that way. But also leverage the resources around you. That might be your qualifications, that might be your education, that might be something in your locality. It might be the tools that you have in the garden shed. It doesn't really matter what it is, but look for what it is, how you can utilize those. So let's take an example of something that's very common for people that's a business that's often thought of as a hobby or an investment. A buy-to-let. There's a changing letting market. So if you're considering a buy-to-let, one of the first things to consider is, what's the nature of the property that you're going to buy? What market do you want to enter? If you already own the property, then you take that a step later and think, well, what market does that satisfy? Is it going to be for students? Is it going to be for young professionals? Is it going to be an Airbnb? Which of those is most appropriate to the resource you have, what it is that you could afford as a buy-to-let, and how you want to use it and how you want to work with it? So all of those things need to be taken account in any business, be that a service, or whether you're going to manufacture something, be that, you know, decorating fairy cakes, which of course has become incredibly popular over the last few months, not least that I've been doing it with my grandchildren. But you look for something and then understand how the market for that works, and can you make a good margin, make a profit at the price, at the right price for the marketplace. I'm going to talk a little bit about branding, because people get confused over branding, and this is just a very gentle introduction to it. It's about integrating design with marketing and product development. There's a solid definition for you. But it's about making sure that the branding that you use conveys a message. Keep it simple. The principle of KISS, keep it simple. It needs to be understood. Imbue your brand, if you develop one, with personality. There are key words that you would use to describe yourself. Keep repeating them and make sure that they enhance that personality. Use stories and other words to, again, enhance that personality. And just to give an example of this, let's go back to the analogy that I gave a few minutes ago of the buy-to-let. So you have to think about, well, first of all, does a property business need a name? Of course, no, it doesn't. It can be very simple. But if you do want one, what's it going to say about you? You know, we could have, say, Ben & Jerry's cheap and cheerful flats. Now, for ice cream lovers, that would, of course, go down very well. But it's not going to encourage a lot of people, you would think, into following that business. And yet, actually, that's almost exactly what one company that many of you will know very well, the Easy brand, EasyJet, Easy Hotels, and so on, did. They actually enhanced their potential in the marketplace by building on that cheap and cheerful brand. It may have developed elsewhere, but that's where they started. Or perhaps if you wanted to go up market a bit more, you might say something like Palace Properties. That would give an image that you're going for something a little more up market, maybe the young professional. And it certainly worked very well if you have a property to let somewhere near the Mall. Or if you want something more family-based, you might call it Home from Home. All of these things are there to give an impression, and this applies whatever the service or whatever the product that you are selling, in order to give a clear understanding to the marketplace, to people, of what it is that you're trying to do. Or my favorite, which a friend of mine has done, and they have a coastal Airbnb, which is just called Sea View. It says it all. It's a cottage on a beach, perfect for families, perfect for holidaying in the UK. Okay, so we've developed the idea for the business. We've made the decision to go ahead. We've considered whether it's the right product in the right place at the right price. We've done all our research. We've come up with a brand. What does that leave us with? What's the next step? Well, there's only one next step after that. You open the business and get on with it. So hopefully that's where you want to go, whatever it is, whether it be a part-time activity or a new full-time career. Hopefully that little introduction just gives you a few ideas of how you should be thinking about your business and the opportunities that it could create for you. Thank you.
Lovely, thank you, Tony. I just want to remind everyone that feel free to put their questions in the chat box. If you've got a question and you want it answered later, if you pop it in the chat box, we will come to that and we can get to there for you. So thank you very much, Tony. I'd like to hand over to Robert now. So Bob Smithson, please. Fire away, Bob.
Good afternoon, everybody. Yeah, my name's Bob Smithson. I'm a chartered accountant. I've worked in a variety of things over my career. So I've been in helping other people run their own businesses and indeed running my own business, which I do now. So I thought it'd be a good idea to start where perhaps some of you are right now. And so there may be some of you here this afternoon who are furloughed right now on the job retention scheme. And that entitles people to up to £2,500 a month at the moment, but 80% of their normal basic pay with a maximum of 2,500. This will be reducing slightly in August, not the amount that the furloughed people receive, but the employer's national insurance will no longer be claimable. So the employers will actually be paying something to employ their furloughed staff in August. Then in September and October, the rates go down to 70 and 60%. So that's coming to an end. We can see an end to that. Some of you may be unfortunate enough. It's unbelievable, isn't it? Some of you may be unfortunate enough to be having been made redundant. Just to point out that you may well know what your redundancy entitlement is going to be, but there is a statutory minimum, which is £538 per week at the moment. And up to the age of 40, you get 1 week's pay for every full year that you've worked at the employers, and thereafter 1.5 times. So, and it's 20-year maximum, so it follows logically. The maximum statutory redundancy, you can get 16,140. I'd like to think that a lot of employers would offer more than that, but of course the big advantage of that is it's tax-free up to 30,000, which means it's there if you decide that you want to do something with it, like starting a business. Just a quick word on personal allowances. Everybody gets 12,500 a year before they pay tax, and I guess everyone knows that. What fewer people know, I think, is that above 100,000 up to 125,000, if you're lucky enough to earn that sort of money, you actually progressively lose that 12,500. So by the time you're earning a gross of 125,000, you have no personal allowances. Now that's an effective tax rate between those two figures of 60%, which is pretty bad. Tax and national insurance up to 37,500, you pay 20%, then up to 150,000, you're paying higher rate tax of 40, and above that 45. So in fact, the highest tax rate for income tax in this country is actually 60%. Don't let Labour Party tell you anything different. National insurance, yeah, between £792 and £4,167 a month, you're going to be paying 12%, thereafter 2%. So it's quite a significant chunk of money. As an employee, there aren't many ways to mitigate your tax liability. One way, and a significant way still at the moment, is by paying money into a pension fund if you're lucky enough to have spare cash to put in. And the taxman will compensate you up to £40,000 for up to the sum of £40,000 in contributions for the tax that you would otherwise have paid on that. Dippin will, I'm sure, be telling you a little bit more about that. But one useful little thing to remember is if you don't use that £40,000 allowance and you've decide in a future year you have got enough money to pay that and more, you can actually use a carry forward system for the last 3 years tax for any unused amount. But again, over 110,000, you start to lose that £40,000. It's a lot of numbers here, isn't there? But again, I think that JGB will be able to help you in terms of advising on this sort of thing. Everybody's circumstances are different. So employed versus self-employed. We've already said that as an employee, you haven't got many opportunities to actually save tax. However, as a self-employed person, there's a lot more areas that you can actually set off against your tax liability. Off payroll working. Now, some of you might have heard of this before, and we'll be talking about it again in just a moment, but it's really where you set up a business, you're actually working, say, for one employer, one company, one customer, and it's in a situation where you would otherwise have been employed, or you ought to have been employed by these people. And the IR35 system was set up, the off-payroll working legislation was set up to try and counteract that. And it can be a problem if you're thinking of setting up your own business. So definitely something to take advice over. I'll explain a little more in a minute. So if we move on to the whole idea of business, setting up a business on your own, should you incorporate? Should you not incorporate? To an extent, it's a personal choice. But the whole idea of a limited liability company is that your liability is limited. That can be, it can be actually taken away, that limited liability in certain circumstances. If you want to borrow money from a bank, they're almost certain to ask for a personal guarantee in the company. And also, because a limited company is a legal person in the same way that you and me, it means that you're acting as a director, as an agent for that company. So if you do anything which is illegal, fraudulent, trading whilst you know you're insolvent, fiddling any tax liability, anything like that, then you can be personally liable for it. So limited liability is great, but there are some exceptions. The big advantage of paying yourself through your own limited company is that you don't have to pay it all as salary, which means that employers' national insurance would be payable. You can pay some of it as dividend. But again, beware of this IR35 trap, because if you are indeed working for one major company, the chances are you could be caught by the IR35 trap, which means that it doesn't matter how you pay yourself. Revenue and Customs will say it's all salary. We want tax, national insurance on it as if you were an employee. So it's something to be aware of. But certainly you can limit your tax liability in a limited company. The current rate of corporation tax is just 19%. And there are other opportunities to limit it. You could make, for instance, your spouse, your partner, an employee of the company, and pay them a salary, especially if they don't actually have income directly of their own. They can use up their own personal allowances. And there's always the option to leave funds in the company if you decide that one year you're going to be zapping over that 100,000 threshold or whatever. And you will still pay the corporation tax of 19%, but that'll be it. You won't have to pay any more until you draw the money out in some way or other. Against incorporation, it is an extra layer of bureaucracy. Company has to, is a legal person, has to submit a tax return in the same way that you do. And there are certain things that have to be filed, annual accounts at Companies House and so on. Also, arguably, it needs a minimum of income to make it worthwhile. That's different for different people. Different people may take a different view on it. I've got a couple of clients who are only really turning over £25,000–30,000, but they decided that they want to be limited because of the limited liability that it gives them some comfort, and that's fine. Just a quick word about dividends. After the corporation tax liability had been paid, it used to be that dividends were free to standard rate taxpayers, free of tax in their hands. That changed a few years ago, and apart from the first £2,000 of dividend in any one tax year, it is now taxed at 7.5% for standard rate taxpayers and at least 32.5% thereafter, because it's a higher rate still if you're earning over 150,000. Just before we move on to the final slide here, I noticed I haven't mentioned VAT at all. It's just worth mentioning, turnover above £85,000 a year, you do have to register for VAT. It may be advantageous for you to register below that, and you can do it voluntarily because you can claim input tax back on your purchases. But if most of your customers are not registered for VAT, you might seem a little bit expensive compared to others if you are registered, because you have to charge them VAT. Okay, just moving on to the final slide now. Been asked to say a few things on buy-to-let. We've heard a little bit about that from Tony already, but here are the tax facts. Taxman doesn't like buy-to-let people, and just recently he's been clamping down on a lot of the benefits that were there before. So from this tax year, mortgage interest relief is now restricted to standard rate. Now, if you're a standard rate taxpayer anyway, it's not a problem. But if you are a higher rate taxpayer, you could find you're losing some of that interest relief if you've taken a mortgage out to buy the property. There's also changes to how expenses are calculated. You used to be able to have a wear and tear allowance, which was just a standard 10%. Now you actually do have to, you can claim for actual expenditure you've incurred, which is fine. If you've got to change a washing machine or a carpet or something, that's fine. You can do that. If you're buying a washing machine or a carpet for a brand new empty building, that's not claimable in any way. It's only replacement stuff that you can claim for. Capital gains tax. Most of us probably know that with the place we live, our principal residence, there is no capital gains tax when we sell. However, if you have rented out the property at all, even if it was your main residence for some of the time, or if it was for none of the time, there may well be a capital gains tax liability. Now, the rules have changed just recently on this. So from the 6th of April this year, if you sell a property, you now have to account for that capital gains tax due within 30 days of completion, which is it's quite a major change, because it used to be it just went on the tax return at the end of the tax year and got paid the following January. You still have to put it on the tax return, because of course you might have made some losses on selling other things, in which case you can claim those losses back on the tax return, but you've got to pay initially an amount on account. Also, there used to be a thing called letting relief. That is now not available. If you lived in the property for a while and then rented it out, you used to be able to get letting relief, which could lead to quite a significant saving tax. That's all gone now. They've taken that away. Finally, just a quick word on stamp duty land tax, which I think is there at the bottom of the slide, is it? I'm not seeing it on mine, but I'm sure it's there. You may have heard recently Rishi Sunak has relaxed the stamp duty land tax thresholds a little bit. So for the first £500,000 of a house sale, a property sale, if it's your main residence, you pay no stamp duty. If you are buying it as a buy-to-let, there's a 3% surcharge on everything, so you do still pay 3%. If you're buying a property to let it out, you do need to hold back that 3%, or to allow for that 3% in your purchase costs. And I think that's probably about it from me. So I'm going to hand over to Dippin, who is now going to tell you, if you've got some money, how you can make more money with it.
Brilliant, thank you. Just one thing before we carry on, could I just ask James and Galaxy Tab just to put themselves on mute? There's a little bit of background noise that's coming on from that we can hear. So if I can ask Dippin to step forward, as it were. Dippin, if you'd like to share the screen.
Just accept my request there, Steve, and then register.
I can't see it yet. And try again.
What?
Yeah, we can see it.
Oh, yeah, got it. Brilliant.
Yeah, it's on. We can see it.
Yeah, done, Dippin. You should be on
Right,
now.
thank you. Right, thank you, Steve. Thank you, Bob. Good afternoon to everyone, and thank you to everyone that's joined us today. As mentioned, my name is Dippin Tanner. I am a financial planner, and I will be speaking to you today about the importance of planning up to and into your retirement and how we can assist you with that journey. One of the most important things that we can assist you with is actually helping you have a bit more clarity around what your goals actually are. And when I talk about goals, I'm talking about your desired lifestyle in terms of what you want to be able to do for yourself and with your loved ones, not just at retirement, but also before. We will work with you to create a bespoke plan that will help you to reach these aspirations. And as I'm sure Steve will tell you as a coach, most people are more likely to reach a goal when they have a robust plan around it, and that's where we can assist. So when it comes to pensions, if we go back around 50 years ago, they were a lot simpler. There was a more definitive age of when you would retire. You knew you were going to retire on that date. And the expectation was that once you had retired, you probably weren't going to survive for very long, unfortunately, 10 to 15 years. And it was a lot simpler time in terms of the way you could save into retirement and also come out of it into retirement in terms of how you would withdraw money from your pension. Now, there's a lot more flexibility around it, a lot more choice that is possible, which is good. Not just around the date that you actually retire, but there's certain things that have gone away. So the surety of final salary schemes is gone, and at the same time, people are living longer. So there's more to think about. In fact, people are actually now living the same amount of time into retirement as they were initially. So for 30 to 35 years, people we know are living up to 100, and it's said that the first 120-year-old is already born. So there's a lot to think about in terms of your accumulation of wealth and whether it will last into the whole of your retirement. This obviously makes things more complex, and it will have more of an impact on families, and it will vary for everyone.
Yeah, we've been out there for months.
The background noise there, but I'll just carry on. Sound financial planning and guidance has become more important in that case, I think. So this is a prime example of what kind of journey people will have to go on to now. As we all know, when you ascend or descend a mountain, it's critical to get expert advice. And we feel this analogy works well with regards to how you accumulate wealth up to your retirement also. And also when you withdraw from that retirement pot, there's going to be bumps and challenges along the way. But having an expert beside you helping you throughout that journey is where we think we can add value and hopefully be able to make it a smoother journey for you. So what does retirement look like for you? It's different for everyone. And so when it comes to retirement planning, there's many questions and decisions that you need to make. And what do you want to be doing? Do you want to be retiring into the sunset and going to a nice country abroad? Or do you want to be around your family and still be in the home that you live in now? Those are all decisions that you need to make when you're thinking about your retirement. So in terms of preparing for your retirement, you start with the end in mind, and that's kind of what that previous picture was talking about. There are factors which apply that are different to all of us, which include understanding where you are, the framework that you're operating in, and engaging with a professional advice is where it becomes valuable to you. There's lots of things that you can think about, and the means of actually saving into your retirement becomes a lot more flexible, so you can really think about what you want to do. So Bob mentioned when he was talking about what your net annual allowance is. So I'm not going to go over the numbers again exactly now, but typically you do have an annual allowance of 40,000, and that is tapered down depending on how much you earn as well. The amount that it tapers down depends on how much you earn, and the rules around it can be quite complex. So we can advise on how to calculate those numbers and what your allowances are, and what you can actually have is what is carried forward. And so those are the sort of things that we can help with, and it's better to get that sort of advice early and really figure out what you can contribute if you have the means to contribute. And going back to what Bob also said around the flexibilities that you have with a limited company, there's certain things you could do in terms of pension contributions from your profits in the limited company that you can contribute before you pay your corporation tax, and you can count that as an expense as well. So that is also something to think about when it comes to your limited companies if you decide to set one up as well. There's things that you can use in terms of planning for your financial retirement also. Next slide. It talks about a lifetime allowance. So this is another allowance that you have to bear in mind when it comes to retirement planning. It's gone down over a period of time, and it's currently capped at 1,073,000 and is subject to CPI increases going forward. And it really limits the size of income that you can realistically take. It's 4% income will work out to about 40,000 a year, and breaching the allowance of 1,073,000 in terms of what you have in your retirement pot can create complex challenges. And obviously we're around to be able to advise on what scenarios you can take action on if that was the case for you in terms of your pension pot being close to that amount already. So in terms of why you should invest into a pension, and why it's good to invest in a pension, when I discuss pensions with my clients, it's that they are one of the many investment wrappers that carry tax reliefs. And the slide in front of you now shows you that in terms of it can improve your return because basic rate relief reduces the real cost and inflates the value, and therefore gives improved performance. It creates more options and flexibility in later life in terms of you have access to flexi drawdown, tax-free cash, and it's actually a pension pot is actually inheritance tax-free. It's outside of your estate currently, the money that you have in your pension. So it can be a good vehicle to pass on money to your future generations, your future beneficiaries. And so as my fellow speakers have mentioned, there's various options when it comes to accumulating wealth, and it's advisable to consider them carefully. But it's not just about your pension. Obviously, you can have buy-to-let properties, you can have other investments, and it all depends around what your ultimate goals are, what your needs are, and what kind of surety you want to have in certain scenarios. So there's lots of things to consider when you have a retirement portfolio, and there's lots of things to consider, not only from a financial perspective, but also the lifestyle that you want to live. And we can obviously assist and show you different scenarios on how that works. One point that we were discussing at the beginning there was about inflation, and how inflation right now at low levels is easy to overlook the adverse effect that it has on your capital and the income it produces. So it is important, because at the end of the day, the example on the screen now, £10,000 in 20 years time may not be the same as what £10,000 is now. It won't be able to buy you as much. So it reduces the monetary value of your capital. So it erodes the spending power of your money and potentially puts the standard of your living at risk. And when we go through a financial plan with you, we try to factor that in as one of the risks to think about. And the inflation impact, although it may not be a prevalent thing right now in society, but over a longer period of time, it can affect the spending power of your money. So it's an important consideration, and we thought we'd mention it here. In terms of you approaching your retirement and what you want to do about accumulating or accessing your wealth, there's a host of issues that become relevant. What are you entitled to in terms of your state pension? What kind of pension plans you have in terms of, do you have final salary schemes that are still in existence, or money purchase schemes only? When should you access the money, and what are your needs and objectives at a particular point of time? And it all reverts to the importance of adapting and continuing to monitor your pension pot and your retirement pot. And just a few key messages to kind of reflect on around this. You should consider the life you want to lead up to and into retirement. Almost everyone will need to save more for their retirement, and if they don't accumulate enough, as I kind of mentioned at the beginning, as we are living longer, you could outlive your savings, and it's important to have that conversation early. We can help you determine how much you will need to save and help you commit to your plan. And the final slide really brings that home in terms of review. We'll be there to help you review your plan continuously through ongoing advice and guidance as your circumstances and aspirations change. So where it's about being there for a long-term relationship and being there to give you ongoing advice as you move forward into later life. And that's me done. Thank you.
Brilliant, lovely. Thanks, Dippin. I'll just hand over to Anthony. Actually, I believe Anthony's going to be talking just to wrap things up for us. Is Anthony there, Picola?
No, I think Tony's just going to wrap it up with questions and answers.
Brilliant. Okay, no problem.
I am. But before we go to the questions, I just wanted to thank everyone for attending, and I hope that we've been able to give you a little taste of the types of areas that we as a practice, as JGB, cover, and the types of services that we would be able to offer to you if you are you need your personal affairs or your business looking after, whether that be that you've got an established business, whether you've got investments, or whether you're looking to go into business. We can help you at every step of the way and make sure that you've got the best possible chance of success. And also, whilst we're going to deal with some questions and answers now, and please let me have any more questions that you might have in the chat box, we will be happy to provide you with answers when you think of it later. So please do contact us and let us know. And the first question we're going to have is going to be for Bob. And Kay asks, is payment in lieu of notice treated as a taxable income, or can it fall under the redundancy tax-free umbrella if it arises as part of redundancy?
Okay, the short answer is it doesn't normally fall under redundancy pay umbrella. In years gone by, it's been put forward that payment in lieu of notice was effectively meaning that the employee couldn't work their notice out, so therefore the employer was in breach of contract. I think that's a highly grey area these days, and if you've got a fairly large employer, the chances are he won't want to get into that sort of hassle with HMRC.
Very informative webinar.
It is possible, and I've seen it happen, but not in recent years.
Okay, and Bob, while we're at it, the next question also comes to you from Ben. Does the relaxation of SDLT, that's stamp duty land tax, apply to limited and SPV company purchases of buy-to-let? And does the 3% surcharge still apply?
Yes and yes, is a short answer. HMRC work on the principle they never make anything easy when they can make it complicated. And in actual fact, there's a blanket provision for limited companies buying property, but there's actually a 15% surcharge or stamp duty charge on all purchases of property. However, there are some specific exceptions, one of them being a property rental business. So hopefully that answers your question. Yes, the 3% does apply. So it's as if it was as if an individual. Remember, a limited company is a legal person. It's as if an individual was buying the property.
Okay. The next question is, we might need to get back to you, Peter, but we'll ask Bob if he has an immediate answer to this.
Right.
Peter is a self-employed contractor who normally works abroad in Central Asia and is paid in US dollars.
Right.
Typically, he spends less than 90 days in the UK and therefore can legitimately claim non-residency status and not liable for any tax in the UK. However, due to COVID, he's been stuck in the UK for more than 90 days already this tax year. Is there any way to legitimately not pay UK tax on the income earned abroad for the current tax year?
Oh, wow.
And as I said, it is a bit complicated, and it might be one that we need to get back to you on just to double check, because it is an unusual circumstance.
Yeah, it's one I would need to take advice on, I think. I mean, to use a commonly used word at the moment, it's unprecedented.
I think what I'd say generally to Peter is, in a normal year, you wouldn't have an excuse if you spent more than 90 days of the year here, because you would have exceeded the limit. However, there have been a number of relaxations and concessions by the revenue that are highly esoteric due to COVID. You will have seen many of them in the press and at the government's press releases. So this isn't, in normal circumstances, I think the answer would be, no, you'd have to pay tax here. But in this year, it may be that there is a concession available, and that we need to check on. Next question for Dipin. Dipin, can you answer a question about the types of assets that can be invested in within a self-employed, self-administered pension scheme, and whether that can actually be whether that can actually cover things like property, commercial property, and so on.
That's, you kind of raised the point there. With pensions, the government don't allow you to have any residential properties, but you are allowed to have commercial properties in your pension. Whether you do that around a SIP or a SAS is something that you need to look into, and it depends on individual circumstances. But you can't have residential, but you can have commercial property. So hopefully that answers your question.
Yes, and are there any other considerations that you should have when you go into that?
I think generally it'll be, you try to do it early. I think that'll be one of the main things. I wouldn't try to transfer it once you've already had the commercial property. Not that it's impossible, but it will be complicated, is what I'd say. So if you're looking to buy a commercial property, you should consider doing it through a pension scheme early rather than doing it at a later stage and try to convert it into your pension afterwards.
Okay. Tony Cooper with a question for Bob. Can I confirm that statutory redundancy pay is 1.5 times 526 for over 40-year-olds? 526 pounds.
Was it 526? It is definitely 1.5 times. Sorry, I did say that. I know I whipped through it so quickly. It's 538 is the figure.
Okay, and that is just to be clear, Peter. That's sorry, Tony. That's the maximum that you can claim. So depending on your income has to be over that amount to be able to claim, or at or over that amount to be able to claim that maximum amount. If your income's under it, obviously it's then related to your actual income level.
Yeah, although it's the maximum figure, it is the minimum statutory figure for salaries over that figure.
Yeah. Okay, I think that's answered everyone's questions so far. Unless anyone's got a question now that they want answering, I'd like to thank everyone very much for coming. I'd also like to thank Bucky, Steve, Bob, and Dipin for all their work in putting this presentation to you. I hope it's met your needs, and don't forget we're here to answer any other questions that you might have about potential businesses or how to go about it, and we hope to hear from you in the future. Thank you all very
Tony,
much, guys.
Tony,
Yes,
before
sir.
everyone goes,
Yep.
can I just make a further comment on the gentleman who was concerned about his residency status?
Yes.
Just been looking up something here while people have been talking, and it says here that HMRC's exceptional circumstances rule can possibly prevent an unexpected UK tax bill. So there is a chance that he won't have to pay UK tax.
Okay, hopefully, Peter, you're still here and listened to that and heard that, and you would have to, I think, then apply to the revenue and claim the exceptional circumstances. But they do seem to be giving a number of concessions at the moment.
I would suggest using perhaps a firm of accountants to do it, maybe even JGB.
Such a good idea, Bob. Excellent idea. Right. Well, thank you everyone for your questions. Thank you for joining us today and for everyone that's taken part. And don't forget, please do be in touch with us if you have any more questions. Thanks, everyone.
Thank you.
Bye.
Bye. Wait,
Bye.
wait.